Welcome to this explainer. Today, we're diving into a strategy that completely flips the script on how we buy stocks. Imagine generating passive income literally just by waiting to buy the stocks you already want to own. Sounds a bit wild, right? But it's actually a mechanism professional investors use all the time to lower their risk and, get paid while they wait for those perfect market conditions. Okay, let's dive into this. Here's our roadmap. First, we'll talk about why you need to stop paying retail price. Second, how to act like the house. Third, we'll break down the Sirius XM strategy. And fourth, understanding the risks. So let's think about how most people operate in the market. You either pay the full sticker price right now, or you set a limit order and just kind of sit on your hands, hoping for the best. But ask yourself this: what if you could charge the market a waiting fee just for agreeing to buy a stock? What if you could act exactly like a smart merchant, charging a fee while you patiently wait for your ideal entry point? Section 1. Stop paying retail price and the trap of the sticker price. Now, it's absolutely crucial to understand the stark contrast between these two mindsets. Paying the sticker price means you buy the stock today at whatever price the market demands, and you're purely hoping the stock goes up. It's totally passive. But getting paid to shop, that means you're literally charging a fee to buy that exact same stock at a discount. You're completely shifting from being a consumer who's just at the mercy of the market to a merchant who is actively setting their own terms. Because think about it, when you just set a standard limit order, you're just sitting on the sidelines. Sure, you might avoid buying at the very top of the market, but you are also suffering from what our source material calls a hidden tax, and that's the hidden tax of missed opportunities. Your capital is tied up, doing absolutely nothing for you, waiting indefinitely for a price drop that might take months, or honestly, might never happen at all. We desperately need a smarter solution to put that waiting capital to work. Which brings us to Section 2. Act like the house, turning the tables. To pull this off, we use a financial tool called a cash-secured put. Now, don't let the jargon intimidate you. A cash-secured put is simply a legal deal you make to buy a stock at a lower price. And in exchange for making that binding promise, the market pays you an upfront premium. That is really all it is. You agree to buy something on sale later, and you get handed cash today just for making that agreement. Our source material for this comes from Brian, a CPA whose main goal is to keep money in your hands instead of handing it over to the IRS or the big banks. And he says it perfectly. Act as the house rather than the gambler. See, when you're the one selling a put, you are the house. You're the one taking in the bets and collecting that immediate cash up front rather than just gambling on a stock's immediate direction. Let's move to Section 3, the Sirius XM strategy, breaking down the math. We're going to look at some real numbers from our source material here to see how this actually plays out in reality. Imagine you're looking at Sirius XM stock. Currently, it's trading at a retail sticker price of $4.89. But maybe you just don't want to pay that retail price. Maybe because you're a disciplined investor who actually did the math, your target discount price, that exact entry point where you'd actually feel comfortable buying the company, is $4.50. In the old way of doing things, you just place a limit order for $4.50 and wait around forever. But instead of just waiting, you use this new strategy. You sell a cash-secured put. By officially agreeing to buy the stock at $4.50, you instantly collect a 32-cent premium per share. It literally lands right in your account. You collect a paycheck today just for making the agreement to buy a stock you already wanted at the cheaper price you already decided on. And this brilliantly illustrates the setup because it's essentially a win-win. Let's say outcome A happens. The stock stays above your $4.50 target. What happens? Well, you just keep that premium. That 32 cents per share represents a massive 7% monthly return, which works out to an unbelievable 85% annualized return on the money you set aside. But wait, what if outcome B happens and the stock actually falls below $4.50? Well, you're obligated to buy the stock at $4.50. But remember, you already collected 32 cents up front. So your hidden discount price, like your true effective cost for those shares, is actually $4.18. You kind of win in either direction. Now, let's pivot to Section 4, understanding the risks and protecting your capital. So the absolutely crucial point here is understanding the ultimate danger. If the stock plummets to zero, you are still legally forced to buy it at your agreed price. If you agree to buy a stock at $4.50 and the company completely goes bankrupt tomorrow, you are legally on the hook to buy those now worthless shares at $4.50 anyway. That is the real true capital risk you're taking on here. Because of that severe downside risk, there are strict rules for safety. You must only ever choose stocks you actually want to own long-term. Please do not just chase high premiums on garbage companies. You have to trust the math and remain a strictly disciplined investor. It's all about stopping the cycle of being a victim of that hidden tax of missed opportunities. And hey, as a helpful resource, Brian notes in our source material that if you want to see his personal conviction plays and learn a bit more, you can join the Hidden Tax channel and his Patreon chat. Which brings us to a final thought for you to ponder today. Knowing what you know now about how the professionals operate, will you keep paying the retail sticker price for your investments, or will you start getting paid to shop? It's a real game changer of a perspective shift that can completely change your portfolio. Thanks for joining me for this explainer. I really hope it opened your eyes, and I wish you a very successful time in the markets.